What's up, guys? Welcome to the Resource Nation. We have a special treat for you guys today. Barry Habib is on yet again. Thanks for coming on the show again, buddy. We really appreciate you taking time out of your day hanging out with us.
I love you guys, and I love what you all do. I think it's so important. The messages that you have are critical, and I'm excited about talking with you today.
Yeah, so today we're just going to have a conversation, podcast style, just going to rap about a few things that actually we talked about the other day, and I was just thinking, I was talking to you, I was like, man, I wish we had the cameras because the conversation was so good. So we're going to bring a little bit of that up. I also want to give you kudos, man. On the show, you were last on in April, and you called the 10-year Treasury back then. You called it right back in April. You said that rates were going to stay low. 2 shows ago, when the NBA and everybody else were saying they're going to go in the 5s, you said they're going to go low, which was very controversial. Here we are, they're low again. You even said on the last show, hey, hold off. This was crazy to even me, and usually I'm kind of in step with you. You said, hey, hold off, fellows, on the refis, and that was contrarian. Rates are going to go even lower. And oh my God, here we are again at a 33-month low. Rates went even lower. So kudos to you, man. You called all of those on this show today. And I may ask you to make another one a little bit later on.
We will. We will have some predictions, and I'll give some rationale as to why. Because the fact of it is, it's not something that's a secret. I think there's good factual basis as to why we see these things unfolding, and based upon that, we'll share that with everybody.
Perfect. And I'm putting handcuffs on you today. So we have, obviously, lenders watch the show, realtors watch the show, and we have a big consumer base now that's watching the show. So you can't use big terms like Fibonacci levels, maybe even the acronyms that we typically throw around. I want you to speak on a consumer level today, really distill it down. Okay, is that okay?
Of course, we always do.
Okay, perfect. So my first kind of question that I know, and people knew that you were coming on the show, they're like, ask Barry about what the hell is happening right now. And so I'd ask, what do you mean? What do you mean? And they brought up, well, Feds raised rates, and then they lowered them. What the heck? And then the Dow's at record highs, but there's a recession coming. And then China's manipulating currency. And now Amazon's in our space. What the hell's going on, Barry? Distill it all down for us.
Okay, so let's take it a step at a time. So let's talk first about the obvious one is rates. So what's happening with rates? Well, there's a lot of different parts of this puzzle. Okay, so first of all, what are some of the reasons why rates are low? So the main driver of interest rates is inflation. Inflation is very, very low. So just ask yourself, why would rates go up significantly from here? Is there a lot of inflation? No. Are we looking at an economy that has pricing pressure, pricing power? No, and one of the big things that people don't recognize is debt levels in a country. So whenever debt levels go up, it is almost a mirror image that you see interest rates decline. It's like a family that is strapped and does not have any discretionary income because they've laden themselves with debt.
Yep.
It happened in Japan, in China, in the UK, in the Eurozone, and yes, certainly in the United States. And if you look at the charts, as debt levels go up, interest rates go down. So if you think that debt levels are going to continue to be probably on the rise, I certainly do with a lot of confidence.
I think everybody does.
That is going to be an anchor on interest rates. It will keep interest rates. No, let's remember now, interest rates don't move in a straight line up or down.
Right.
They're going to vacillate. But if you would have this image in your mind of a child with a yo-yo on an escalator, the escalator is heading lower. So while the child's yo-yo may go up and down and you may have some intermittent moves higher, the overall direction is going to be lower. And this is very important for us to understand, because if you look over the longer term, I see interest rates lower. I see interest rates the lowest they've ever been. We'll talk more about that. But what I also see is that we have to understand it's not in a straight line. So there's strategies that we can employ here. And the strategy, if you're a consumer, the strategy, if you're a loan officer, is that what you'd like to do here is see if it makes sense to refinance. Now, just as of this morning, the data came out that 9.7 million households, can not just benefit by a refinance, but the real big number here is they can benefit by a refinance of 0.75%, which is very significant. So, roughly speaking, for every $100,000, it's $50,000 a month at 0.75%. So what I would say to you is if you think rates are going to go lower like I do, rather than completely hold off, well, maybe do a refinance now. and do it with as little closing costs as possible. And you remember on our talks in the past, I said, do not pay upfront MI. That's a stupid thing to do. Do not pay points. That's a stupid thing to do because you will not hold this mortgage for a long period of time. And what I see happening is the mortgage that you're doing for customers today, and same thing I said to you, the mortgage that you do today will be refinanced in the future. Do not think of loans at one at a time. Always think of them as the mortgage you're doing today and when is the next one we're going to be doing. And that's how you should be talking to your customers. When I started doing that, it escalated my production dramatically because it tied them in, but also gave me much, much more of a advisor role with that customer, because not only was I bringing in the life events that customer would have, getting married, getting divorced, having kids, empty nest, all those things that occur life-wise, but I'm now bringing in my expertise from the economy and able to show them that we're contemplating this to make the right decision for you today. So rate is a secondary issue. Rate's important, but it is secondary to strategy.
Can you put that in context, though? Like you said, rates are going to go lower, and everybody's like, happy. They're at 33 months low. I mean, they're great right now. What does that mean? Does that mean 3.25? I mean, can you make that prediction here? Like, what do you think that looks like?
Let's just jump right into it. So, a few years back, I called 1.37, 1.39 on the 10-year Treasury, and everybody thought I was like psycho. Okay, went to 1.37, so I was pretty darn close. I was 2 basis points off, but I see us going lower than that. So, if you take a look at today's 10-year Treasury at 170. Could we hit the 120s? Could we hit 110? Could we hit 1? Yeah, it's all really, really possible. But I will promise you that we're going to go beneath that 139 or 137 level that we had just talked about. We're going to test that level. We may not break it the first time, but we're eventually going to break it because there's too many factors dragging us down. We are going to see a recession. I know people say, well, how could there be a recession? The stock market's high. The stock market always goes up prior to recessions. What you really want to focus on and look for is when the unemployment rate starts to tick higher. So 3.7% now, don't panic if it hits 3.8, 3.9, but if it hits 4.1, this is a really reliable recession indicator. And then look at the yield spread. There are inversions. What does an inversion mean? It means that the shorter term maturity is actually giving you a higher rate than a longer term commitment. So it's kind of like you walking into your bank and you say, I could see a 3-month CD, a 1-year, a 2-year, 5-year, 10-year. And oh my goodness, that 5-year or 10-year is not giving me as much interest as the 3 months. So I'm going to put my money in a 3-month CD. Unnatural. And you're right to think it's unnatural.
Love the analogy.
Correct. It's called an inversion.
Yep.
So why do these inversions occur? Well, the inversion is telling you that something is sick. Okay, it's kind of like when you see somebody walk into your office, they got the red eyes, the runny nose. I'm not going to give you a big hug because there's something sick here. Okay, so what the deal here is that longer term maturities care about inflation because that's going to be around for a short term. You don't care about inflation. Inflation is not going to take its toll, but inflation will erode the fixed payment that you get because it means things will cost more. So if you're getting a fixed payment return, you can't buy as much over time. So when you take a look at your longer term maturities, they care about inflation. So what's going to drive inflation? Well, look, if all of us wanted to buy, if we all wanted to sleep out at the iPhone store, at the Apple store, because we wanted the latest thing out there, Apple's not going to put it on sale. Okay. So they're going to charge as much as they can. A strong economy means prices are going to be going higher. Softness in the economy means inflation will be weak. We don't have pricing power. So because of that, it's telling us that the economy is not as robust or as strong as you might think. The shorter term cares about things like the Fed. And the Fed at its present levels, even with the most recent rate cut, is still, at least what the bond market is telling us, is still too high. And I'm telling you, the Fed's going to cut at least twice more, probably 3 times more, maybe 4 or 5 times is what you're going to get from the Fed. And I know nobody's forecasting this as many times, but you're going to get a series of rate cuts from the Fed. They loathe doing it. They don't want to do it, but we have to do it because if we want to stay competitive currency-wise, we want our exports to be okay. We have to do this. The bond market is forcing us to do it.
I was going to ask you a question, and you kind of already hit it about the economy being sick with the inversion. Is that also indicated by the Fed's wanting to raise rates but not being able to do so and so quickly having to come off of that? Are we sick as an economy?
So here's the thing. If you look, the world is so interconnected today, okay? If you look at the numbers in much of Europe, if you look at the most recent numbers that came in Germany, I mean, that economy is hurting right now. Same thing in Japan for a long time. China's numbers are appalling. Okay, China is a geriatric ward. Okay, the average age is 41 years old in China. They have the male to female population totally distorted because of bad policies that they had in the past. So they are in trouble. Now, when we take a look at the United States, we're in better shape, However, we have some weaknesses, and when the world gets sick, it's very difficult for us not to catch that cold. Okay, it's when the world's sneezing and sniffling, we are going to pick up some of that. Okay, so what's going to happen is we will see this slowdown, and we're going to see it from levels that we're actually quite vulnerable. We're in the longest expansion we've ever been, and it doesn't mean it can't go longer, but it's unnatural for us to go this long. There's going to be a recession. That's not the call. The call is when. So I've been saying for a long time that 2020 looks like the date. Could it be 2020? Could it be 2021? Could it be 2019? It could be. I'm saying that seems like a reasonable target for one. And stock prices can go up leading into a recession, but then drop very precipitously. Between 36 and 50% is what you can typically see during a recessionary period. So just be smart, be careful.
Yeah, you brought up a great point about the expansion. You snuck it in. I want to slow you down there. I think it's 122 months. Is that what it, like 10 years?
10 years.
Yeah. And so, guys, we learned this lesson already, 06, 07, 08. Things don't always go up. To Barry's point, like, I think this is the longest recovery ever, right?
Ever.
And so at some point, to your point, like, things have to come back down, right?
Well, we're a cyclical economy, and it's only natural for these forces to occur. So, as I mentioned before, the yield curve, we started to talk about this, is a very good indicator. The unemployment rate is the number one indicator. Number two is the yield curve. And the yield curve, when you start to see these inversions, it's telling you that you're probably likely to see a recession. It's very accurate. Now, the one that many people look at, we're already inverted. The 3-month is higher than the 1 year, 2 year, 5 year, and 10 year. So that's inverted everywhere. The 1 year is inverted against the 2 year, 5 year, and 10 year. The 2 year is inverted against the 5 year, but not yet against the 10 year. It's only 9 basis points difference. That was 300 basis points just a couple of years back, 3 years back.
I was just going to ask you that.
It was 3. So that meant
about that.
Picking round numbers, 10 year at 4, 2 year at 1. That's a 300 basis point, 3% or 300 basis point spread. That's come down to 200, 100, to 50, to 25. Now we're 9 basis points.
That's crazy.
9 basis points. So whether we go inverted or not, but here's the thing. If you think about it and nobody figures this stuff out, we're already inverted. And I'll tell you why. Because nobody is contemplating the uniqueness of what has occurred. We had the Fed unwinding their balance sheet. That was known by many as quantitative tightening, or QT. If you take and contemplate the effect of quantitative tightening, we're already inverted because that accounts for about 20 basis points. Yeah. So we're already like 10 basis points inverted. If makes you sense. Figure, and nobody's thinking that far down the road, but you have to think about these things. So we're already inverted there. And when you start to look at these inversions, it is telling you that we are at a point that is a very reliable indicator that probably within the next year, you will see at least some sort of recession. Now, recessions tend to mirror the expansion. And because the expansion was relatively shallow, the recession will be probably relatively shallow. But still, in a recessionary period, the reaction of the Fed is to cut rates. The reaction of interest rates is to drop. And mortgage rates historically, and you can rely on this, will drop. So you asked me a question, where do we see the 10-year? What I see in mortgage rates is you more than likely have a very good chance of seeing about 0.5%, maybe a little bit more, drop in your 30-year fixed rate mortgage than you are today. Now, remember, a lot of people ask this question. They say, well, I see the 10-year having big days sometimes where the 10-year really does well and goes down a lot, but mortgage rates aren't following in lockstep. Well, congratulations. You finally got it. Mortgage rates do not follow in lockstep with the 10. I've been saying this for 25 years, okay? The 10-year is a great barometer, and it can give you direction. It will give you sentiment. It's great for forecasting direction. If we see the 10-year going lower, well, mortgage rates will go lower over time. How much can vary? And there are specific reasons, not just that never in lockstep, but think about this. When the Fed said, we're going to stop quantitative tightening, and we're going to now start to reinvest those maturing treasuries and mortgage-backed securities, the one difference that they made, which they snuck in there, that unless you're really paying attention, is that their reinvestment will no longer be in mortgage bonds. The reinvestment will solely be in treasuries. Yeah. Therefore, treasuries get a little extra turbo boost that mortgage bonds don't. So on good days, treasuries will respond better than mortgage bonds do. On bad days, treasuries will be hit softer than mortgage bonds are hit.
Great explanation.
Because you have the Fed buying in there. Okay, so we have to understand these things. And then there's the other thing. I'm going to try and make this simple. It's got a funny, crazy name. It's called convexity buying.
Yeah.
Okay. So here we go. You ready? I'm a fund manager. You're a fund manager. And if, as a fund manager, I have to declare to my investors, if you want to invest money with me, you're not going to say, hey, Barry, go invest it in anything you want. God, you got all my money. No, it has to be specific. I give you a prospectus that says, here's what I'm going to invest it in. So if I'm going to invest in bonds, I also have to specify the duration, because shorter duration bonds give you lower yield, but there's a lot less risk because they pay off more quickly. Longer term bonds, if it's a 20-year or 30 or a 10-year, a lot can happen in 10 or 20, 30.
Right.
Much greater risk, and you should get a greater return under normal circumstances. Not happening today, but normally, okay? So if I say my duration is, let's just say 10 years or so, okay? Now, if I say it's between 7 and 12 years, my target's 10, 7, you have to give a little leeway there, right?
Yeah.
So mortgage bonds would normally fall into that category because a lot of times people would have a mortgage for 7 years or so. Even though it's a 30-year mortgage, you'll move,
right,
you'll pay it off, this and that, you'll refinance. But today, with interest rates not just low today, but expected to be even lower, it's creating duration to shrink. So if I'm that fund manager, guess what? I can't hold mortgage bonds now because the duration expectation is too short. So I have to actually unwind some positions, but more importantly, what I'm buying with my new funds constantly coming in can't be mortgage bonds. How do I match the duration? I'm not going to outright sell them. So I have to increase the duration. So what I buy is on the longer end of the curve. I buy 10 years. I might even buy 30 years. So what that means is that money is going into this, and it causes a spiral, convexity, which means that the more rates go down, the more that rates go down, because all these fund managers now have to match duration.
Wow.
Start buying longer maturities, pulling longer maturities down further.
Interesting. That's interesting.
And when those longer term maturities go down on the 10-year, it invariably gravitates mortgage bonds down too. So we're in a situation of convexity buying. The opposite can happen with convexity selling. When rates go up, you notice that all of a sudden they start getting away from you.
Right.
And you see that. So it's called convexity buying. And that's what we're in now. And look, it's a good place to be if you're in the mortgage and real estate business. We haven't talked about real estate, but I hear all these idiots talking about the end of the housing. I've heard it forever. I've heard it for the last 7 years with all these people. Oh, housing's terrible. I mean, I see it on TV. I see it even in our industry. Please stop it already. Okay. The housing market is really strong. It is at really good levels. Affordability in certain areas is a little bit tougher, but affordability today is better than it was. Rates are helping that, of course, but the housing market, there's just too much demand, not enough supply. Do you know the single family market is underserved by 25%. That means there's 25% more demand than builders are putting up. It is simply a supply and demand story. I'm not saying we see 25% appreciation. I don't want 25% appreciation, but 3, 4, 5% appreciation, if you understand the amazing magic of leverage, can create tremendous amounts of wealth. So
the
please
important
stop.
part, and I'm glad like you read my mind, because I wanted to say, hey, consumers and realtors, lenders, you just heard a lot, and it may scare some of you, but we already spoke about this last time where you pointed out real estate does well typically through a recession. I'm glad you just said that. So it's not all doom and gloom, guys.
I'm going to explain that to you. Yeah. Okay. So what's the bad thing about recession? The biggest bad thing about recession is unemployment goes up. That's the biggest bad thing. So round numbers, we'll try and make it simple. So unemployment rate goes from 4% to 8%. Okay. That's pretty bad, right? Mm-hmm. So 160 million people in the labor force. So let's just say it's 80 million families. Okay. So just to use some numbers. So 4%, 80 million in round numbers, 3 million more family. When I said 4%, it's because the unemployment rate went from 4 to 8. So now 4 million families are not working. The last thing they're going to look at is buying a home. So you took them out of the marketplace, right? But do you realize that for every 0.5% drop in interest rates, you're going to get 6 million families that can now qualify for a home that didn't? So it gets overwhelmed by sheer numbers, sheer volume of people now able to buy homes overwhelms the people who no longer want to or can buy a home because they now don't have a job, unfortunately. So this is what people don't get. It's so rare that people look at the entire spectrum. You have to be able to look at the whole picture when you talk about these things, because it is not a simple connect the dots. There is a lot of moving parts here. And the reason why housing does well is because rates drop precipitously. It makes it a much better option than renting. It makes it much more affordable. And it also allows an overwhelming amount of people to come into the market who couldn't qualify for a home, which is a greater number than the people now who are unemployed and won't buy a home.
Love it. Let's switch gears. Good Lord, that's a lot of information. I hope you guys, you might have to pause it and go back, guys. Sometimes I even have to talking to Barry. But let's switch gears. Realtors, consumers, take a break for a second.
I try and break it down, though.
Dude, it's a ton of information. I love it. This is why we're leveraging you as much as we can today. So,
and by the way, I mean, and I talk to people who are just some of the smartest minds in the world. I spoke the other day with one of my, idols is Lacey Hunt, who is just one of the most brilliant guys in the world. Guy's turning 77. I was just talking to him. Lacey he's a genius, okay? And he feels very, very comfortable with exactly what we're laying out here. He's big on the debt levels. He's big on the velocity of money is slowing. He sees a recession. He sees rates going to the lowest levels. David Rosenberg, who's a dear friend of mine, I just spoke to him a couple of days ago. He also kind of said, Barry, I completely agree with you. His call is for under 1% 10-year treasury. So, that may very well be. Peter Bookvar, same philosophy on housing. One of the smartest ladies in the world in housing, Ivy Zellman. I had lunch with her the other day in New York, and Ivy really feels really good about the housing market. And what Ivy's saying is that what we have been saying too is the housing market is a couple of things you have to understand. The media screws this up because they don't realize that the housing market they look at housing as, okay, the driver of GDP, the amount of sales, okay, maybe that slows down a little bit, but then we all look at housing, the investment. What will prices do? So that's how we look at it, but they're looking at something else, and what they're saying, it's poo-poo, that doesn't affect appreciation, okay? In fact, when you look at things like iBuyers, think about this. iBuyer popularity actually could help housing in a very unusual way. It's because they are pulling inventory out of available sales and for a period of time, putting it on a temporary shelf and making those homes unavailable until they transfer them. So they're actually decreasing and sucking out inventory, which makes you have to bid for the other inventory that's available. It's an amazing phenomenon, but nobody's considering it. The other thing is that what I want you to also think about is when you have home price appreciation, the way that we're looking at it here at modest levels, affordability is also something where you don't have to be dollar for dollar. So if homes go up at 3%, you don't need income at 3% because you don't use 100% of your income for it. There is another point that I wanted to make on housing. I just got to remember where I was. I'm trying to recall it because there's a lot of stuff I'm trying to think of here. But the other point with that I had just made with pulling inventory off the shelf, it is something that we're seeing a decrease in the amount of available homes for people.
Yeah. I mean, that's a big thing.
Here's the point I was going to make. I'm sorry.
Go ahead.
Just came back to me. Apologize. And there really is more than one housing market. If depending on where you are and where your price points are. So if you have a housing market where, like kind of your entry level home is like $400,000, okay, or less, that market's on fire. Good luck. Talk to anybody who's looking for a home in that area. I keep getting outbid. I can't. They can't even find a home or buy a home. It's really, really tough. Then it's that next level. So let's just say if it was 400 or 500, then it's like 500 to 800 or 500 to $1 million. That's an okay market. It's that upper echelon that's slow.
Yeah,
that's slow. Yeah. So when you're talking about the housing market, something's hot, something's slow. Where? You're talking about the top third? Yeah, it's slow. Got it. No problem. You're talking about that middle third, that next bump up? It's okay. You price your house right, it's going to sell. You're talking about that bottom third where most of the action is, it's on fire.
San Francisco and Seattle. So again, I wanted to switch gears. Thanks for all that intel. It's almost overload. You're like, man, like you just dumped a ton of information. So switching gears though to loan officers, we had a funny conversation. And for consumers and realtors, we sometimes reference refi versus purchase percentage. And so let me just explain this to consumers. So typically, loan officers will serve the purchase community, but also help their consumers, their friends, their clients with refinancing, right? And so a healthy percentage is a mixture of both. And sometimes the industry will say, well, the person that is purchase driven will have a 95.5 purchase to refi percentage. And most people would say, that's amazing. Great job. You're helping the purchase community. But Barry kind of had a different contrarian mindset that we talked about the other day. Can you explain that? Because actually, you got fired up, but this is good. This is really good. We need to hear it.
So listen, if you have that badge, I'm 95% purchase, please rethink that. Okay. Look, I admire the fact that you want to say, look, I want to serve my realtors. I want to do, but by the same token, don't you want to serve the previous customer? Don't you sat down with that customer, you looked them in the eye and you said, hey, baby, I want to be your lender for life. I'm going to take care of you. I'm going to be your advisor. I mean, you don't want to be a one night stand, right? You want to serve that customer. And the only way for you to do that is go back and help that family save a ton of money. Because let me tell you something, if you don't, guess what's going to happen? Somebody else is going to take that customer because that customer's smart. They hear it all over. They know that rates have come down. Yes. They know that the Fed's cutting. And even if that doesn't affect interest rates on a mortgage, they're still going to get their curiosity piqued. They're going to start making calls and they're going to do that refinance. They're going to save money, probably not give them the good advice that you would. But guess what? Not only do you get penalized for losing that deal, you kind of deserve to get penalized, but you get an extra penalty. Because now the next time that they do a mortgage, they're not coming to you.
Right.
They've got your best friend on the block.
Yep.
Okay. And you are making yourself so easy to be overtaken by the FinTech companies by not serving your customers. So people get this mistake and they say, well, I have to do my realtors and serve my, yeah, you do.
Yeah.
You do. Guess what? You got to do both. And you got to do both. Great. Yep. Okay. There's no excuse here. It is no longer acceptable to just know how to fill out a mortgage app and consider yourself a mortgage professional. Oh, I know how to read a tax return. Good for you.
So does a computer.
Right. So does a computer. You have to decide to take that next step up. And guess what? You're going to have to work hard.
Okay? I loved it. You called it out. Lender for life, guys. We've used this as long as I've been in the business. And you made a great point. It like punched me in the face, even though I had the same conversation, oddly enough, 2 days earlier with my entire team, kind of having a similar conversation. But yeah, lender for life, guys, means exactly what you said, lender for life. And Barry said, we got to be looking out for their best interest. That doesn't mean we ignore the purchase business at all. You got to do both. And that's what preserves you from the Amazons and the Quickens of the world.
You got to work hard. Look, it's a beautiful day. You want to go play golf? Sorry. Okay? No.
Sorry.
Sorry. No. Go play golf.
Stop it. No.
9 months ago, when you're playing solitaire at your desk, when it was really
that was the time.
Go play a lot of golf.
Yeah.
You don't want to miss the opportunities when they're in front of you. Okay. Yeah. You have to have imbalance. Don't be balanced work-wise when it's slow. Take more time off. Goof off more. Have a great time. But when you have an opportunity like this, look, if you said to the financial gods and the mortgage gods, said, "Oh my goodness, I just wish I had a good housing market and low interest rates
were low."
Please. And then one more that nobody thinks of. I wish that my clients on my refinances had a ton of equity so I could refinance them out of MI. I could do amazing debt consolidation. It would be easy to qualify them. Please you got it.
Yeah.
You got all three. You hit the trifecta. And you're telling me you want to go play golf or take a beach day or take a whatever. Are you kidding me? You don't have that many
prayers
days.
Have been answered.
Yeah. You do not. Your prayers have been answered. And now what are you going to say? Sorry, I'm not interested?
Yeah, not enough. Also, purchase demand's higher than supply. So there's a fourth.
Yeah, exactly. You're right. So you know what you're going to do? There's going to come a time when it's not like this, and you say, "Boy, I wish it was like that. I wish I would have done more." Don't do that to yourself.
That's when the universe backhands you and says, "I already gave you that."
Exactly right. You have it. You have it. You can create so much wealth for your family right now. You could do so much good for your customers right now. You can build your reach and your business into the future so that, you know what, when it gets slow, your customer database and your reputation will be so strong that you can withstand the slow markets, and you'll have an enormous nest egg to help you. This is the time to work like an animal right now.
I'm so glad you said that. I would chop down the show to that last 2 minutes if I could, because that's amazing, and it's what we need to hear. Another controversial topic that I've actually stayed out of. I've had people try to pull me in a few times. I kind of want you to talk about it. Banker versus broker. And before you answer, all I've heard today was opportunity. Opportunity for realtors, consumers, and loan officers. Nothing but opportunity, which is really kind of my thought on banker versus broker. There's a bigger thing happening there, and there's opportunity for all of us. I've stayed out of it. How do you feel about it?
I've stayed out of it as well, because I don't really want to get in the midst of it. But I will say this. I love brokers and I love bankers. And they both do a great job. They're both awesome. Okay.
Amazing professionals.
You think about the growth of the broker community. You got to give Anthony Casa so much credit. I mean, he's such a great champion, and he has rallied brokers and done so much for him. I mean, I know Anthony. I think the world of him. He is such an incredible guy, and he's so giving. Like he works so hard on behalf of the brokers. Like, they are so lucky to have an amazing leader like him. So he is just doing an incredible job. The big picture that I want everybody to just think about, though, is that, yes, we all compete. Of course, everybody's competitive, right? Yes. So you can be broker versus banker, or even in the broker community, you compete for a loan, right? Or the banker, you compete. Everybody's competing for that loan. There's only one person that gets the loan. There's no second prize, right? Yeah. You don't say, oh, you came second, great, you got it. You know, it's winner take all. So,
right.
But here's what I want everybody to please understand, is that, you know, your brothers and sisters, brokers or bankers, these are all good people, number one.
Agreed.
Okay? And the real enemy that I'm worried about is the FinTech companies, because they have, look,
100%.
Richard Barton pretty much has said wants to eliminate you, okay? And he did it to travel agents.
Yes.
So, you know, Richard Barton, if you don't know, is the CEO of Zillow, and he's a genius. He's brilliant, okay? I mean, these are really smart people with no shortage of funds to back them up that are trying to take your business away from you. So how do we do it? You know, we've got to be smarter. We've got to be better. And serve our customers and our real estate agents, you know, to the best of our ability.
Yeah. Yeah, I do. I love both sides. I look at independent mortgage bankers and brokers as you said, brothers and sisters competing for business, friendly. But I agree, man. We have a bigger competitor that has way more money than any of us combined. So if they leverage that, it's going to be a different world. And so I think we should, you know, work together to fight against those fintechs. I'm glad you called that out as well.
Yeah. I mean, that's an important thing. You know, like I said, brokers, bankers, they're all such good people. You know, I mean, they're good people out there. I do think that it's very important for us to understand that the way that we're going to protect ourselves from this onslaught of fintech is to truly be an advisor, and not the BS of putting it on your name tag and calling yourself one. You can't give what you don't have. And if you want to give advice, you really have to have it. The other thing that drives me nuts is I hear it all the time. Rates come down, and you get one day when rates go up, and I see it all over social media. That's why I lock everyone. I never think about it. Are you freaking nuts? Okay, will you please
very unfiltered today. I love it.
Will you please stop it? Okay, because how's that strategy? How many pissed off customers do you have right now? How many pricing exceptions have you had to put your company through? And how many transactions did you lose because you locked your customer at a horrible rate, and rates have come down dramatically, and now they're smart and they're seeing it and they want either out or a lower rate? How are you handling that? Wouldn't it be a lot smarter to, instead of being a robot that can be replaced by fintech, by the way, be an advisor? Just remember this. By definition, the less advice you give, the less of an advisor you are.
Yeah.
And I will tell you, need to be more of an advisor today, not less of one. You need to up your level of education. I'm not saying you need to be an MBS Highway subscriber. Just up your level of education so that you can advise that customer. You need to understand the financial markets. You need to understand them.
How did you say that again? Because that was great. The less of the advisor, the less of the advice you give, the
less of an advisor you are. I mean, that's factual. That's by definition.
Yeah, and everybody, I mean, I'm traveling next month to speak in Idaho about what we can do against the fintechs. There you go. I mean, that's going to be one of the top answers, right? Like if you want to set apart yourself, you know, you have to be an advisor, and you've been on the show several times explaining that exact point. So I love how you wrap that up.
They pick their mind up of whom they're going to choose, right? They pick their mind up of whom they're going to choose in the first 5 minutes. Okay. You know, one of the many reasons you are so successful is because when people talk to you right away, they get a great feeling, and they know you're super smart, okay, and they know you can help them because you've put in the time, and knowledge and the education to be able to give. You have so you can give, okay? But you have to put in that work. You have to put in that knowledge and education, because in the first 5 minutes when that person makes the decision whether they want to do business with you or not, what knowledge have you imparted to them? Have you just talked about qualifying? Because they get that anywhere. Or are you talking about the financial markets? Where do you think rates are going? What about the recession? What about the yield curve? Why is the yuan so important? We haven't talked about that, but what can we do to understand that and explain all of these events that they're dizzied by, that they don't really get, and then they hear you on the phone explaining it. It's like, oh my goodness, what am I going to miss if I don't do business with you?
Yep.
And look, even if your rate is not the best rate, they'll be more forgiving and root for you to try and win them over. And even if your rate is the best rate, if they don't get that good vibe from you and they're not learning from you, they'll try and pick you apart. I mean, that's just the way we are. Think about anything you buy with any salesperson you work with. Either you're rooting for them or you're not. How do you root for them? Trust through knowledge and trust through truth.
And realtors watching, everything Barry just said and that we talked about was kind of in that lending space. But it all is 100% true for you.
100%.
You guys just had Amazon come into your space. And so you have to answer this question as well about what sets me apart. Everything you just heard applies to you as well. So if you need to rewind and rewatch that, please do so, because it's true for realtors and lenders and consumers watching. That's why you want to work with a professional in your local real estate or lending market. That's exactly why, versus a computer, that's Amazon or Zillow, because that's exactly what you get, is just a computer versus an actual trusted advisor in your community that has the well-being of the community and yourself, right there. Small is beautiful. They care about the town. They care about you. They got to see you face to face. They're not across the nation, and it's an actual person. So, and
by the way, this applies to both real estate prices as well as interest rates. Is what's going on in China, what's going on with currency battles.
Yep.
So I'm just going to try and break it down very quick and make it simple. So it takes right now about 7 Chinese yuan, that's what their currency is, or renminbi, but let's call it the yuan, to buy $1 US. And that's a lot weaker. It used to be just a little over 6. It's gone to 7. So think about how smart China is. Okay, so China, it used to take like 6 and change to buy one. US says, here's a 10% tariff. Why did the US put a 10% tariff on? Because that would make Chinese goods more expensive to purchase for us, right? So that means instead of buying Chinese goods, I'll buy either from another country or maybe hopefully domestically. Right. That's the whole idea behind stopping tariffs on. So China says, well, that's okay. We'll just devalue our currency 10% and negate the effects of the tariff.
Right.
Now, that has a lot of implications. So how do they negate that? Well, they put more yuan into circulation and they fix a price point. Now they fixed the price point a little over 7 yuan, which means it takes a little bit more than 7 yuan to buy $1. So what that means is, think about this. If you're from China, like 15% of the California market was purchased by Chinese. 15% of the upper end of the market. 15%. 1 out of
That's crazy.
7 homes.
Yeah.
That's a lot.
Yep.
It just cost you 10% more to buy that home. Think about that. And that's why you see a little bit of a slowdown in that market from the Chinese buyers, okay? Because to bring your money over, you're not getting as good of an exchange rate.
Yep.
So it affects real estate if you're listening. Now, why is that so important for us? Is because when you weaken your currency, it makes your exports able to be more affordable. And we like that in the United States. So how do you do that? One of the things you have to do is lower interest rates. And that's one of the reasons there's so much pressure on our central bank to cut rates.
Full circle, man.
Our currency is relatively strong.
Yep.
So the Fed will continue to cut rates because it's a war. Philippines just did it. Thailand just did it. India just did it. You have these countries and they're doing greater cuts, more aggressive cuts, and this is going to continue to happen. Interest rates in Germany just went to their lowest rates on the 10-year in history, greater than 50 basis points. So think about this. You want to put your money away for 10 years, you've got to pay them 0.5%. Here's my money, and here's 0.5% to take it, okay? There are mortgages out there with 0, or even they will pay you. They will pay you interest on the mortgage. Now, you still have to pay principal, so you're still writing a check, but it's the principal less what they give you back.
It's crazy.
Crazy.
Yeah.
So could interest rates go to 0 in the United States? I think it's a bit of a stretch still, but it's not an impossibility. But the key that I would look for is around that 1% 10-year level. I think that it is a very real possibility to see that, because look at every place else in the world. In the UK, where are they? 40 basis points. We've got $15 trillion of negative interest rates around the world. You look at where we are. You look at Switzerland. You look at Germany. You look at Japan. You look at, there are so many places around the world where our interest rates look like, oh my gosh, 1.7 is tremendous compared to all these other countries.
Yeah.
So what happens is money flows into the U.S., makes our dollar stronger. We've got to cut rates to stop that.
It's a great interview, man. This is Fox, CNN, newsworthy for sure. I loved it. Thanks so much for your time, man. I got to wrap you up there. MBS Highway is money, and it's always been good, but things are so crazy right now, it's even better than it has been. So if you're a loan officer or realtor, definitely check out MBS Highway if you don't have it already. I mean, if you work for a company that doesn't have it, I encourage an enterprise relationship. We'll put that link in the comment section below. I know Barry's kind enough to answer questions. If you have them, throw them in the comment section below. Tag Barry, tag me. We'll make sure that we get to all of them. I was going to ask you if you want to make any bold predictions, but you kind of already have. You said rates could go, a quarter to a half point lower than they already said.
They're going to get there. I'll say not good. They will. Rates are going to be the lowest you've ever seen. Real estate's going to be fine. 10 years going to break the lowest level ever. Mortgage rates probably 0.5% lower than where they are over time. We're going to get a recession. These are all going to happen. Feds
are going to continue to cut, you said?
Yeah, Fed's going to cut. You can bank on that. You can bank on all of these, okay? And you're in a good place. If you're in real estate or mortgage, you pick the right industry to go through all this stuff.
Love it. Love it. Hey, share, tag, subscribe today. Make sure you ask questions down below because we covered a ton, and I appreciate your time, Barry. We'll see you guys next week.